Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So my kids were in town over the weekend, and as dads are prone to do, I got into a back in my day conversation with them. I don't even really know how we got into it, but we started talking about writing checks. And I was trying to explain the tedious task of balancing a checkbook when you only got a statement once a month. Right? Nobody does that anymore. At least nobody under the age of probably about 70. We just go online, we look at our balance, we can see what's gone through. Things generally go through instantly anyway, so we don't have to worry about, the lawn guy waiting 2 weeks to deposit our check and, forgetting about it or forgetting to write the check in and then getting our bank balance all messed up. It's not really a thing anymore. But let's use this as the jumping off point. Let's go back to that day. Imagine back in the old days, I tell you that I had $100,000 in my bank account, which, when I was a kid back in the 70s and 80s, that was a good amount of money. And so I insisted, I've got $100,000, and you might be a little skeptical. So you say, well, let me see your bank statement. And I say, nah, it's all there, trust me. And this just keeps repeating. I brag about my big bank balance, but refuse to ever show any proof. And then one day, we're hanging out and I casually mentioned that, oh no, I never balance my checkbook. I don't need to. I've got all this money in there. And you'd probably ask, well, how do you know that there's $100,000 in there if you never balance your checkbook? What if I just said, trust me, right? The money's there. Now, there might be $100,000 in that account or not. Here's my question. How much faith would you have in my bank balance? You'd probably feel a little bit skeptical, right? Even if you generally trusted me, you'd still think the whole thing is, a little hinky. You might be thinking, if it's really there, why not just show me? And that's exactly how I feel about the gold in Fort Knox. I tend to think that it's probably all there, but I don't know that it's all there. And the fact that people wig out at the mere suggestion of a formal audit to prove that it's all there adds to the suspicion. It makes even somebody like me who kind of thinks it's probably there think, maybe it's not. Speaking of which, what is up with Rand Paul? And why did he just let himself become Secretary of Treasury Scott Bessent's little pawn? I'm going to delve into that question in the show today, and I also want to explain what's going on in the currency markets. Some of the moves that the U.S. recently made to support the Japanese yen reveals that the dollar's status ain't what it used to be. But before we delve into all of that, I do want to thank you so much for watching the show. Every week I say this, every week I sincerely mean it. I appreciate the fact that you guys are out there. I love my audience. It means a lot to me. It really does. I know there's so much out there vying for your attention. So thank you for spending a little bit of time with me every week. Now, if you're getting value out of the show, I assume other people will as well. I would love to spread the word, get more listeners, get more ears, and you can help do that. If you would just go to wherever you listen to your podcast and just write a quick review, or if not that, just give us the 5 stars or the thumbs up or whatever. And also if you could share these episodes on your own social media platforms, it really helps kind of grow and spread the news, because we want to get this stream of information out there. There's so much garbage out there in the mainstream when it comes to investing and finance and monetary policy and the things that we talk about here. So we want to get the counter narrative out there, right? The truth, in my view. So if you would do that to help out, I would really appreciate it. But, as I said, just thank you so much for listening and being part of the Money Metals Midweek Memo family. So I'm going to get to Rand Paul goes to Fort Knox here in a minute, but let's start with a topic that's really more relevant to our lives and is actually going to have probably more impact than the political dog and pony show we've got going on in D.C. As I already mentioned, last week the U.S. intervened in the currency markets to support the Japanese yen. And the way the U.S. executed this move reveals that the dollar's reserve status is slowly melting away. And of course, that's really bad news for a country that depends on demand for its currency to support its borrowing and spending. I talk about de-dollarization quite a bit here on the show, and I think it's a very significant factor because, if the world didn't need dollars, all of the Federal Reserve's newly printed money would just stay here at home, and we'd ultimately end up with hyperinflation. But since the world needs dollars, it soaks up some of that dollar supply. So simply put, the central bank couldn't print to the extent that it does without global dollar demand. And without Fed money printing, there wouldn't be debt monetization, where the Fed basically takes U.S. debt, it buys treasuries, turns it into money, and injects it into the economy. This whole monetary system is built on a house of cards. Borrowing, spending, money printing, all of that is predicated on the dollar maintaining its role as the reserve currency, and that role is being diminished. Now, I'm not sitting here trying to tell you, tomorrow you're going to wake up and, oh no, the dollar's no longer the reserve currency. I think the dollar will probably be the reserve currency for a long time to come because, generally speaking, it's the cleanest dirty shirt in the laundry hamper. But if we continue on this trajectory of borrowing, spending, money printing, and debt, eventually the house of cards will fall down. And we're seeing signs that it is getting shakier and shakier all the time. It's like we have this house of cards and it's built on this table, and some dude's turning on a fan and keeps cranking up the volume, right? That's kind of what we've got going on here. So typically, when the U.S. intervenes in currency markets, it buys a foreign currency using dollars. So, in this case, it would use dollars to buy yen. And so the sudden surge in demand for yen, or whatever currency they're buying, it strengthens it relative to other currencies. This is really all supply and demand, right? When demand goes up, prices generally go up along with it. So if the demand for yen goes up, the strength of the yen relative to other currency goes up as well. Now, the downside of these kind of transaction is that the sale of dollars can weaken the U.S. currency. So if it did it this traditional way, the U.S. would be in danger of weakening the dollar. So this time was different. The Treasury Department took a little bit of a new tack by buying yen, not with dollars, but with euros. So the U.S. dipped into its supply of euros in its reserves, and it bought some yen, thereby strengthening the yen, but also preserving the dollar's strength. And of course, then it's at the expense of the euro. So on the surface, it looks like the U.S. was willing to help Japan, but was concerned about maintaining dollar strength. Notably, according to the Financial Times, the move, quote, blindsided the European Central Bank. U.S. officials didn't even inform the ECB until after they ran this operation, which is a pretty big breach in etiquette, right? If you're going to do these kind of big operations, you're supposed to kind of let people know. And the U.S. did not have the courtesy to do that to the European Central Bank, as far as the reports show. So in an op-ed published by the Financial Times, UC Berkeley economics professor Barry Eichengreen argued that the way the Treasury executed this currency intervention reveals a deeper concern. He wrote, quote, "The message is that U.S. Treasury Secretary Scott Bessent and company worried that selling dollar securities to prop up the yen would put additional strain on the long end of the U.S. Treasury market." So now, what is he talking about? Let's kind of clarify this. The sagging demand for U.S. Treasuries is a growing problem for the U.S. policymakers. We've talked about it here on this show. It looks like we are entering into a secular long-term bear market in bonds, which will mean less demand, lower bond prices, higher yields. As bond demand drops, prices fall. supply and demand. Inversely, yields rise. So that's just kind of the way it works, right? This increases the federal government's borrowing costs when the yields rise, right? If the 10-year Treasury is 3.5% instead of 2.5%, well, that means that the U.S. government is having to pay more interest expense. With the U.S. government already spending over $1 trillion every year in interest expense alone, Uncle Sam cannot afford to lend money at even higher rates. That's why this is such a big problem. That's why I keep saying that the Fed is going to have a hard time raising interest rates in this environment. It's just a huge problem for a government that depends on borrowing and spending. So policymakers have to find a way to support Treasury demand. They can't be allowing it to erode further. Eichengreen said that the selling of euros rather than dollars was likely partly a function of, well, that's what the Treasury had on hand. But there's almost certainly more to this entire operation than that. And he wrote, it is also a way of not asking the market to swallow additional treasuries sold to reduce dollar exposure, which would have aggravated an already delicate situation. Now, to really understand what's going on, I have to kind of give you a little bit of an overview of the mechanics of currency intervention. How does this work? What are we talking about in general? Well, when a country wants to strengthen its currency relative to others, it typically sells a foreign currency, usually dollars, and then it buys its own currency with the proceeds. So in Japan's case, it would sell dollars and buy yen. But what if the Japanese Treasury doesn't have enough dollars on hand? Not enough cash in the bank? Well, it can sell dollar assets, treasuries, for dollars, and then buy yen with the proceeds. So the transaction goes like this. Japan sells U.S. Treasury bonds. It gets dollars. It uses those dollars to buy yen, thereby strengthening the yen. And that's exactly what the Japanese have been doing for at least a few months. The country's foreign currency reserves fell by $75.6 billion in May. And according to Bloomberg, this broadly matched the scale of yen intervention that month. And Fed custody data shows a decline in Japanese U.S. Treasury holdings that are consistent with this liquidation. So it's exactly what they're doing. They're selling U.S. Treasuries, raising dollars to strengthen the yen. Now, enter the United States. Bessent doesn't want Japan to sell Treasuries because if it does, it's increasing the supply, putting pressure on the price, and as the price drops, yields rise. So Bessent offers to step in. Now, when I say it offers to step in, we have no idea how this goes down. It could be that it was like, hey, we can help you out here and it'll help us too. Or it could be Bessent kind of laid down the law and said, look, Japan, you're not going to sell treasuries anymore. And we'll figure out a way to help you out. But this can't be because it's hurting us. So by stepping in and buying yen, the U.S. kind of kills two birds with one stone, right? The yen gets a boost, and there is no increase in the supply of treasuries out there in the open market with the rising yields, which are a huge problem for the U.S. So in effect, U.S. intervention reduces the amount of dollars Japan needs to raise by liquidating U.S. treasuries. Now, why is the U.S. involved in this at all? Well, the United States has a vested interest in maintaining a stable currency market. And these kind of currency interventions, they're not unprecedented. They're not even that unusual. But they're typically reserved for times of excess volatility. Now, there is no question that there has been significant volatility in the Japan currency markets, in their treasury markets. So I guess this situation fits the bill. But the U.S. wasn't just trying to help out a friend, right? It's trying to keep a lid on its own problem, a tanking treasury market, even as the U.S. needs to borrow more and more all the time to keep up with the ever-increasing spending. Now, there was another move that signals Japan is willing to cooperate with the U.S. and prop up the treasury market, or was coerced into cooperating, because I'm not so sure that this was what Japan really wanted to do. But Japanese officials say they will use the Foreign and International Monetary Authorities Facility, and we're just going to call it FEMA for short, to conduct future currency support operations. So what in the world is FEMA? We're not talking about the FEMA, the Federal Emergency Management Association or whatever it is. We're talking about FIMA. And in the early stages of the pandemic, foreign institutions, foreign banks, they needed dollars and they started selling treasuries to raise cash. And this created severe volatility and dysfunction in the treasury market. So in response, the Federal Reserve created FEMA in March 2020. And this facility allows foreign monetary authorities, central banks, and other institutions to obtain dollars without selling treasuries outright. Instead, the Fed loans them dollars, and then the foreign governments pledge the treasuries as collateral. So FEMA loans are very short term. They're a maximum of 7 days. However, these loans can be rolled over. So this is a place that Japan can tap into to raise cash in order to support the yen without actually selling the treasuries. They're just pledging them as collateral so they don't end up out on the open market. It's a great idea for the U.S. Again, I'm not sure that this is really how Japan would want to do it, but I get the distinct feeling that in some way, shape, or form, the Trump administration has said, this is how you're going to do this, because we can't have you raising yields and messing up our bond market. So let's go back to Eichengreen. Remember, he's an economist at Berkeley. And he said the U.S. intervention and Japan's willingness to use FEMA indicate, quote, the dollar's status as a reserve currency is not what it used to be. He went on, central banks are accustomed to holding foreign reserves in dollars because markets in U.S. Treasury securities are liquid. Central banks hold U.S. Treasuries because they can be freely bought and sold and used in interventions, but not now. At least not in unlimited quantities. Instead, we see the U.S. Treasury stepping in with euro sales as part of its contribution to the intervention, thus limiting the volume of dollar sales needed by the Japanese authorities. Eichengreen said that the bottom line is the U.S. is reluctant to see foreign central banks use dollar reserves due to the potential ramifications for its own financial markets. Now, this raises a question. Why in the world would you hold dollars as your reserve currency if you can't use them when you need them? And that's exactly the point Eichengreen is making. He says, quote, this is telling us that the dollar is not the attractive reserve currency it once was. And when this message sinks in, other countries will redouble their search for more attractive, readily usable alternatives. Reserve diversification is apt to gather steam. And reserve diversification is another way of saying de-dollarization. If we can't use dollars, if the U.S. is going to handcuff us, then we need something else. A report in Fortune put it even more bluntly. That strikes at the heart of dollar dominance, which is in part derived from the immense size and depth of the U.S. debt market. So, central bank gold buying is part of this reserve diversification that Eichengreen mentioned. If you're not going to have dollars, well, what do you get? Gold. In a note, capital economics economist Kyron Tompkins said the move increases the appeal of holding assets like gold. Quote, the ability of central banks to conduct FX operations without triggering concerns from U.S. administrations about the impact on U.S. bond markets could provide fresh impetus to central bank demand for gold. So there you go. That's why all of this is relevant. Whenever you see anything that has to do with currency markets, money, and bonds, gold is always implicated because gold is real money. Gold is the substitute. Actually, gold isn't the substitute. They've substituted all this other fiat garbage for gold. Gold is real money. So when we talk about currency debasement, when we talk about currency manipulation, all of these things are bullish for gold. Central bank gold buying has been one of the main pillars of support for the gold bull market over the last few years. And I think it's a big reason that the yellow metal has held the $4,000 level despite significant interest rate headwinds and kind of this general lack of interest in gold by investors in the West. I should, on a side note, mention that Asian investors have been buying the heck out of this dip in gold prices. And I think some folks on this side of the pond are going to be sad that they didn't in a few years. Anyway, I'm driving at the point that there are a lot of indicators pointing to a continuing gold bull market. So this dip is the time to buy. In fact, gold may already be breaking out of the range-bound pattern. We've seen a big jump up in the last several days with the expectations of a Fed rate hike fading. So take some time today. Maybe go check out our specials at Money Metals. Go to moneymetals.com, and in the top toolbar, you'll see specials. There's a little flamey, fiery thing there that kind of draws your attention to it. And if you go to that page, I'm going to call your attention to some special pricing on quarter-ounce sovereign gold coins. So I'm talking about quarter-ounce Canadian maple leafs, Austrian Philharmonics, Chinese pandas, and more. These are fractional coins, and they're a great way to buy gold if you don't have over $4,000 on hand to buy a full ounce coin. And we have very low premiums on these quarter ounce sovereign gold coins right now. So check that out. There's also some really good specials on silver that are going on over there. You'll find all of that over at moneymetals.com. Okay, so let's talk about Rand Paul. And let me preface, I like Rand Paul. I love Rand Paul's dad. I think Rand does a lot of good things in the Senate. In my opinion, and this is my political bias, but I think he's one of the better senators there. But man, his little tour of Fort Knox is a complete head scratcher. I cannot for the life of me figure out why he pimped himself out to support Treasury Secretary Besant's Fort Knox gold assurances. Now, you'll remember a few weeks ago, Besant insisted that all of the gold is in the vaults at Fort Knox. He said, I haven't been there, but people on my staff have. The treasurer has been to Fort Knox, and I'm happy to say all the gold is present and accounted for. Okay, dude, thanks. I mean, I guess we just take your word for it, right? No, we don't. And I actually wrote about this and talked about it on the podcast a few weeks ago. So on Monday, Paul shows up at Fort Knox, and he spent 1 or 2 hours inside the gold depository, and then he came out and he boldly proclaimed, yes, the gold is there, all approximately 147 million ounces. It is impressive, he said. Now, with all due respect, Senator Paul, it is absolutely impossible for you to make that statement after wandering around inside a vault for a few hours. Good grief. You know, when you do the math, you find that there should be over 300,000 gold bars inside Fort Knox. You take the amount of gold they say that's there, you think about standard bars, over 300,000 bars, well over 300,000 bars. In fact, there may be more than that because a lot of the gold that is held in Fort Knox was actually formed by melting down gold coins in the 1930s. Remember that whole gold confiscation thing that Franklin D. Roosevelt initiated? Well, the U.S. collected a lot of gold coins. I should note that people just turned them in. It's not like the government went house to house taking people's gold. The gold that got confiscated was the gold that people willingly gave back to the government. But regardless, they melted that down, but they didn't purify it. So these are non-standard bars. They have irregular weights, and they don't even qualify for international settlements primarily due to the lack of purity, which kind of is a problem with gold reserves in the first place, but it is what it is. But regardless, we're supposed to believe that Rand Paul spent a couple of hours or so inside this depository and then can emphatically claim that all, 300,000 plus bars of gold are there. I'm sorry, I call BS. So between Besant's statements last month and then Paul's little propaganda tour on Monday, it's almost as if there's this concerted effort to quiet calls for a legitimate audit of U.S. gold reserves. And who better to calm those voices than Rand Paul, whose constituency is among the most vocal supporters of sound money. Money Metals CEO Stephen Gleason put it pretty bluntly. He said, Senator Paul has been rolled. All it took was giving him a fun chance to go into the mysterious facility. And in a post on X, Gleason noted that Money Metals operates a precious metals depository twice the physical size of Fort Knox. And this is what he said, and I can't disagree with him. We are especially appalled that a giddy Senator Rand Paul would implicitly make a mockery of proper auditing practices and whitewash decades of U.S. government mismanagement here, presumably as a thanks to Treasury Secretary Scott Bessent, who granted him this fun field trip today. No way in hell Senator Paul can or should suggest America's gold is fully accounted for based on a half-day visit. Even more importantly, is it encumbered? And is it okay that 83% of it is unacceptable on global markets due to lack of purity? What a shame. Ironically, Rand Paul sponsored the Gold Reserve Transparency Act of 2025, along with Senator Mike Lee, who is the prime sponsor. And that would have produced a comprehensive audit of U.S. gold reserves. Sound Money Defense League Director J.P. Cortez said the tour and Rand's subsequent insistence that the gold is all there raises serious questions. J.P. posted this on X. He said, "You co-sponsored a good bill that would have actually produced a full audit and accounting of America's gold. Instead of pursuing that, you decided to go with a field trip to Fort Knox and to trust me, I swear it's all there after a few hours. Why would you do that?" Why indeed? I'm not even going to try to speculate as to why Paul came out with that statement. As my friend Dave Benner put it, it's truly sad that the guy who rightly blasted the trust the science narrative is now shouting trust the financiers. But politics is politics, I guess. But don't allow this publicity stunt to take your eyes off the need for a legitimate audit. And, if you're not familiar with general accounting principles, an audit involves a tad bit more than walking around on a guided tour. In a proper audit, every bar would be counted and inspected by an outside entity like real auditors. Serial numbers would be matched to records. The gold would be assayed to verify its weight and purity. The details of the audit would be published and available for public inspection. None of that has happened ever, as far as I know. Furthermore, audits include confirming chain of custody. We have no idea whether or not the Fort Knox gold is encumbered. Was it loaned to other entities? Mobilized in currency interventions? Pledged? Leased? Swapped? Do any other parties have full or partial claims on the gold in the vaults? We don't know because there is no published audit for us to examine. And yet, in so many words, Rand Paul tells us, no worries, the gold is all there, I saw it. So here's the $6 billion question. Why won't they just audit the gold? Why is there such a persistent refusal to even entertain the idea? In fact, people like me are ridiculed for suggesting we need an audit. They'll say, well, we saw in 1974, they went in those vaults and they showed us the gold was there. That was a publicity stunt, just like this Rand Paul thing. So what's the deal? Why is there this resistance to it? I mean, I guess we're just supposed to trust them because it's the government. Now, if you ask me, that's a bigger reason not to trust them. Think about this. If a private business refused to audit its books and yelled at people when they suggested that they needed to audit the books, somebody would shut them down. But, Uncle Sam plays by different rules, right? So maybe it's just me, but when somebody gets all upset when I suggest checking their work, I suspect their work might not be quite up to snuff. I mean, think about it. You don't have anything to hide. Why wouldn't you want the gold holdings to be verified? Why wouldn't you want to calm these voices in a real way with a real audit? What's the harm? Why is this insistence that it isn't necessary when audits are necessary in every other business setting? I mean, I'll tell you what, if I was running a gold depository, and I guess I kind of am, the company that I work for runs a precious metals depository. I was there during an audit. I've seen how rigorous it is. Money Metals Depository is larger than the U.S. Bullion Depository, and our team knows a thing or two about auditing. We have internal and external auditing. So if it's my business, I'm clamoring for public audits because I want to give people that assurance. I want to calm public fears. I want people to know, hey, I've got what I say I've got, and I'm going to protect it for you. I would want people to know everything is on the up and up. The only reason I would resist an audit is if I knew I had something to hide. So what's it going to be? Are we going to take Besant's and Paul's word for it? The gold is all there? Or is somebody finally going to step up and do the right thing and audit the gold? Probably not. Because, politicians are not known for doing the right thing, at least not the right thing for us. So you got to protect yourself. And, you certainly can't trust the government to maintain the value of your money. They're not going to do it. The plan is to devalue it, right? The plan is to devalue your money by more than 10% every 5 years. That's what they're doing, right? You have to be cognizant of that. You can't trust these folks to take care of you. You've got to figure out how to take care of yourself. One way you can do that, you can preserve your wealth by saving in sound money, in gold and silver. And that's why every week I say, call us, talk to a precious metal specialist, 800-800-1865. Ask questions, figure out how gold and silver can be worked into your portfolio. They can answer your questions, the technical questions, the practical questions. Why would you want to maybe buy quarter ounce coins instead of full ounces? All of these questions, you can ask them. These folks are fantastic. They're there to help. If you don't like talking on the phone, you can go to moneymetals.com, chat with the precious metals specialist online. Or, if you want to just buy some of those quarter ounce sovereign gold coins or some American Eagles or, some silver bars, you can just go to the website. You can find the product that you want. You can order it online. We will ship it right out to you, or you can store it in our state-of-the-art bullion facility, where your gold and silver will be audited on a regular basis, unlike some places we know. So do it today, 800-800-1865. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure to sign up, get yourself on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that drops every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. This week, I'm going to be talking to Michael DeLenzo over at the Silver Institute. We're going to be talking silver, so that'll be coming out Friday. Thank you so much for listening to this show. I hope you enjoyed it. Remember, the dollar's not what it used to be, but you can still have a great rest of your week, and you can rest assured that I will be back behind the microphone, God willing, and the creek don't rise next Wednesday.